Welcome back. Investors are digesting more earnings from Canadian banks. Royal Bank of Canada has missed estimates in its latest quarter after setting aside more money than expected to cover possible loan losses. On the other hand, Canadian Imperial Bank of Commerce, CIBC, beat estimates as it set aside lower than expected loan loss provisions and had strong capital markets activity as well. Our next guest is a money manager who has been watching the Canadian bank stocks for many years, and he remains slightly underweight the sector in his client portfolios. John Zechner joins us now. John is chairman and founder of Zechner Associates. John, thanks a lot, as always, for helping us out. I'll just quickly, John, show viewers some of the basics of these bank results. Royal Bank of Canada has narrowly missed expectations with adjusted earnings per share of $3.12. That's 6 cents less than expected. Here are some of the highlights of the Royal numbers. Adjusted profit in the aggregate came in at $4.5 billion. That was up 8% from a year ago. Its core personal banking unit had a profit of $1.6 billion. That was up 14%, boosted, however, by the addition of HSBC Canada. Without HSBC Canada in the mix, the increase in personal banking profit would have been 8%. And the number that's getting a lot of attention at all of these banks, the provision for credit losses, $1.4 billion. That was up 55% from the same period a year earlier. Here's a quick look at CIBC, a clear earnings beat, $2.05 in adjusted earnings from CIBC, much more than the $1.88 expected by analysts. And here are some of the highlights at CIBC. Adjusted profit rises by 17% to just over $2 billion. Canadian personal and commercial banking profit rises 4% to $734 million. And if you're looking for a reason why the bank was able to drive adjusted profit up by 17%, it looks like it's the capital markets unit that did much of the heavy lifting there. Profit in capital markets was up 20% for CIBC versus the same period a year ago. And the provision for credit losses number was $605 million, and that was up 18% from a year earlier. So there's a lot there to talk about. John, what stands out to you?
Well, there were a lot of similarities and differences across all of them now that we can look back and review. I mean, the similarities is that the strengths are really all in the same areas, capital markets and wealth management, which really sort of makes sense, Paul, when you think about it. Obviously, TSX hit record levels, and we've had strong stock markets now for much of the past year. So, that's reflected, obviously, in their capital markets operation, bond trading, stock trading, investment finance as well. Wealth management continues to grow and has been one of their best areas of growth, going forward. So that was consistent basically across all the banks. The difference is in the loan loss provisions, and as you just mentioned, Paul, and particularly since it's somewhat of a discretionary item because it's not really the level of non-performing loans; it's the reserves against performing loans. So is this, for some banks, a more conservative outlook to be protecting against views that are a little bit more dire going forward, or are the others a little bit too optimistic? So that's sort of the interesting play. And as you said, a bit of the the miss on the RBC numbers this morning. Clearly, when I go, one by one, Bank of Montreal had their problems with the Bank of the West acquisitions, and then they seem to have cured them for the last 2 quarters. But now, their provisions increased again. Commerce, like you say, had probably fewer provisions, so maybe a better loan book. Scotia was somewhat conservative in their outlook, and people a little worried about given what their Latin American exposure was going to be, and because Mexico and Canada are in the crosshairs of the trade war, whether that would be worse, and it really wasn't. So the big beat overall was National Bank, and their sort of capital markets were just huge, which sort of surprises me because you don't really think of them as much of a major player in the capital market. But particularly the integration now of Canadian Western Bank, which is now we're seeing the tail end of the benefits that you saw to Royal Bank for their acquisition of HSBC, because the one commonality, Paul, among all of them is that overall growth is slow because you're moving along with the Canadian economy. You don't have further expansion. You don't have penetration. These big banks dominate. It's not like the U.S. where you've got regional disparities and you can grow by acquisitions. That's not happening really in Canada. There were only a few left and they've been taken. So your overall growth is going to be slow. So for bank shareholders, there's no reason to go out and sell the banks based on this. I don't think you certainly got decent dividend yields in most cases. You got active stock buybacks there as well to support the stock price. But having said that, earnings growth looks relatively slow going forward. It's economically contingent, and the valuations are trading at the high end of their of the past ranges. So we've taken a little bit of money off the table here. I mean, we put TD on for a trade late last year. It's moved up like $20, and now you still got the same risk, but less of a valuation discount. So we took some money off there, reduced a little bit on Royal. We don't own BMO right now, but I think there's some upside in Bank of Nova Scotia because of some of the expansion into both the U.S. and certainly what they got in Latin America, and maybe becoming a stronger play in wealth management of the domestic bank. I mean, they've become sort of the sports bank. So it's a lot to pick from in between. Overall, we're a little bit underweight. You can't be in Canada with the banking sector is too big to ignore, but I don't sort of see why you need 30% of your portfolio in bank stocks right now. That's for sure.
Okay. Let's move on to another big story in the pre-market and quite likely a big story in regular market trading as well. Nvidia. Investors appear to have liked what they heard last night from the company and its chief executive officer. The company does say that U.S. restrictions on its ability to sell chips to China will hurt, but the number that they provided, I think it was a hit of about $8 billion U.S. in revenue, is a number that the market was expecting.
Yeah, it really is incredible, Paul, when you think the number that they generated even after that $8 billion plus hit. And I mean, it's almost 2 years ago now to this quarter, May of 2023 when this started. And you got to put it in perspective. I remember that quarter, the expectation was $9 billion in revenue, and I think they did something closer to 11. And that was the beginning of the realization that AI and this data center build out, they had a massive market share, high margins, and they were the go-to basically only player there, and this started this run. So from that 9 billion expected quarterly revenue, now they're expecting 44 billion next quarter, 45 billion, even with restrictions in China. It just shows you how dominant they've been. We still own it. It's still our largest tech position. I'm gonna lean a little bit more to taking it down a little, because I think going forward you can't replicate this. That growth rate is going to slow down. You can't probably with a 90% market share or 90+% at very high margins is really only in one direction. It can go is down from there, and you're going to start to get more competition, not only from the other players, the AMDs and the Broadcoms and others, but also from their customers, because you realize a lot of this is the structure of the architecture of the chips that they're doing, within the framework of these the data centers, and a lot of their hyperscaler customers. Obviously, we know, Meta, Alphabet, Microsoft, a lot of these are developing their own infrastructures on this basis, so which they want to probably ultimately reduce their reliance on Nvidia particularly. And then the China factor. I don't know how this plays out. Building a plant in China is not going to go well in the U.S. And this, trade wars. That's the sort of third big issue today, obviously on the the stock market agenda. We'll see that going forward. But for now, data center build-outs continue at a great rate. Their earnings will continue to grow, but they're decelerating. It's not compared to some of tech, compared to cybersecurity and others, it's not the most expensive stock out there. But if you start to get a slowdown, it isn't on earnings. On sales, maybe it is, and that's the problem. You start to get some sales growth slow down. Do your gross margins come under a bit of pressure, and then suddenly your earnings, maybe they're not even growing, and that could be a problem going forward.
John, thanks a great deal, as always, for your insight. That's John Zechner. He, of course, is chairman and founder of Zechner Associates.